Hello and welcome to episode 502 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
Good. We've had a nice mini break, haven't we, for the Easter period. We tend to do it most years, actually. So it's quite nice to have the long weekend with the family and have a break from the schedule, having to record and do different things around Money to the Masses. So that was really nice. But I'm now enthused and pumped to be back. And as such, we're going to do something slightly different today. Same three pieces that we would usually do in terms of structure. But Andy, I'm going to let you go first because you're going to do a piece on the podcast this week. But before you tell me what that is, I'll let the listeners know what the other two pieces are. So gold has been hitting new all-time highs. So if you're into investing at all, you can't have not heard about gold's rally to over $3,500 per ounce in the last couple of weeks. So I want to talk about gold. We covered it on the podcast about 6 months ago, where there was a really good piece. I've shared it on socials actually, talking about the outlook for gold, and where I stated that there was this potential for further upside because we were at all-time highs then. Well, we are pushing ever higher, and there's a whole host of reasons why that's happening, which I want to discuss. Also, touch upon the possible outlook for gold. But even if you aren't an investor, there's a very good reason you need to listen to this part of the podcast, and it's in relation to home insurance. The second piece I'm going to be doing is in relation to probably the most famous investor ever, Warren Buffett. It's off the back of a piece I was asked to contribute towards for a national newspaper. Warren Buffett was actually the only billionaire, or the only billionaire in the top 10 billionaires in the world, to make money in the week after Donald Trump crashed stock markets when he announced his reciprocal tariffs. So I was asked, well, how did he do that and what could ordinary investors learn? So I wanted to expand upon that and make that a piece on this week's show. And finally, Andy, you're going to be doing a piece on...
Yes, I'm going to be doing a piece on the Help to Save scheme, which is a savings account that's specifically designed to help people who are receiving working tax credits or universal credits. And the reason I'm bringing it to the podcast today is because there's been some positive news, because that scheme has been extended. It was due to end this April 2025, but it's been extended now till April 2027. But possibly more importantly, the eligibility rules on that have changed as well, which means potentially more people can access the Help to Save scheme. So let's start off with exactly what this Help to Save scheme is. It's essentially a straightforward savings account, but with additional perks. Now, the first thing to mention is it's managed by National Savings and Investments, the same people who do premium bonds, and savers can save anywhere between £1 and £50 per calendar month. Now, the key point is its flexibility. You don't have to put money away every month, and you don't have to save the same amount. So you could chop and change whether you save at all and how much you save, so long as it's between that £1 and £50 per month. But here's the attraction. The account pays a 50% bonus. So for every £1 you put into that account, you'll get a 50p bonus. But it's important to understand how these bonuses are paid, because they're only paid twice in the account's lifetime. Let's briefly explain what I mean by the account's lifetime, because the account is slightly different to a normal savings account. It has a time limit on the account. So from the day that you open the account, it will only stay open for a maximum of 4 years. After that 4-year period, the account shuts down, the money gets transferred back to your nominated bank account, and you can no longer take out a Help to Save account. So the account will last for 4 years only, and once you've had that account and it's closed down and the money has been returned, you can no longer take out a Help to Save account. It's a one-time deal. Now let's just quickly go through these bonuses that are paid out, these 50% bonuses, because they are a little complex. They're paid twice. The first bonus is paid after the account has been opened for 2 years, and it's calculated as 50% of the highest balance that your account reached at any point during those first 2 years. Now that's quite interesting, because it can potentially mean that you can withdraw money from that account within those first 2 years, yet your bonus will still be calculated based on the highest point reached. So ultimately you could have less in your account but still get your bonus paid on the highest amount. So let's assume you saved the maximum amount you could every month for 2 years. You'll have paid in and saved £1,200 in that 2-year period. The highest point you would have reached would have been in that final month, which was £1,200. You'll get paid a bonus of 50% on that £1,200. You'll get a £600 bonus. But let's just quickly explain how that bonus works in terms of the highest point reached. Let's assume you pay £50 a month in for, say, a year, achieving a £600 balance. You then couldn't afford to put much more in, and actually you withdrew £100, meaning after 2 years you had a £500 balance. You would still get paid on the £600 balance you had the previous year. And so in that example, you'd get paid £300 on top of what you've already put into the account. So it's important to understand that saving regularly will actually benefit you, even if ultimately you have to access some of those funds. Now, I've explained the bonus after 2 years. The bonus after 4 years is slightly more complex, but I'll make it really, really simple. The 4-year bonus is paid on the highest point reached after 4 years minus what you already achieved after the first 2 years. So let's put some numbers on that to make it really make sense. Imagine you managed to save the maximum £50 every single month. After 2 years, you'd have that £1,200. Your first bonus would be 50%. So that's £600. That would be paid directly into your regular bank account. It doesn't get added to your savings account. That's quite important. If you then carry on saving £50 a month for the next 2 years, you'll save another £1,200, and that will bring your total savings to £2,400. Your second bonus is then calculated on the additional £1,200 you saved in that 3 and 4 year period. So you can see there that makes a total of £1,200 in government bonuses. And to remind you, that is a tax-free bonus. You don't pay any tax on that, just for saving £2,400 over the 4 years.
So you've summarised that brilliantly, Andy, and it does sound such a good deal that I don't think many people know exists. So the eligibility criteria has now been extended so more people can access the help to save concept. So who is actually eligible to join the scheme?
Yeah, so previously, if you were on universal credit, you needed to meet a minimum earnings threshold, which was roughly equivalent to 16 hours per week of work at national living wage. That threshold was a barrier, and it meant that quite a lot of people couldn't access the scheme. But from April 2025, that requirement has been removed. You just need to have earned £1 or more from employment or self-employment in order to meet the monthly assessment period before you apply. So just to reiterate exactly who can qualify for this Help to Save scheme, it's any individuals receiving working tax credit, but also now individuals receiving universal credit who earn £1 or more from work in their last monthly assessment period. So what HMRC are now saying is people should really be checking their eligibility on this, because it does mean that over 500,000 people have now become newly eligible for this new scheme that wouldn't have previously been.
So interestingly, you mentioned the eligibility for this scheme, but also in regard to universal credit, savings amounts, the amount you have in savings, can influence whether you are eligible for that particular benefit. So how does this kind of oddly interact with that, doesn't it? So you encourage people to save, but if they save, then, or you have a certain level of savings, it means you might not be eligible for universal credit. So how does this sort of tally up?
Yes, that's a common concern. Does the Help to Save scheme affect certain of these means tested benefits? You do need to be careful. There are capital limits that people need to be aware of for things like housing benefit and also universal credit. But crucially, the bonus that's paid from the Help to Save scheme isn't used in the calculations in terms of your income assessment. So that's one thing to be mindful of. And the £2,400, assuming that you're able to save the maximum £50 a month over those 4 years, is a significant amount of savings, but it's still well within that £6,000 threshold that individuals need to consider in terms of their total capital when looking at these benefits. So it shouldn't impact people in terms of their means tested benefits. But of course, if their savings from other sources, when totaled with the Help to Save scheme, do mean that they go over that £6,000 threshold, that's where there might be a problem. So it's just something to be mindful of.
Now, before the podcast, Andy, you mentioned a nuance that you spotted about the lock-in in terms of eligibility for this particular scheme.
Interestingly, with regards to the Help to Save scheme, it is only assessed on the day that you apply for the account. So there's almost like a lock-in feature to the Help to Save scheme. You don't necessarily need to be eligible all the way through the 4 years that the scheme is operational for. It means in practice, once your account is successfully opened, assuming that you're eligible at the time that you opened the account, you don't need to stay eligible for it. So let's say, for example, you're in a period in your life where you're having to rely on certain benefits. It'll be a great time to look at the scheme, open it up, assuming you can afford to save some money into that scheme, because you don't have to worry about constantly being eligible for the scheme. So the eligibility is based on when you open the account. That's the really important point. So do make sure that you keep this in mind, even if you're not currently eligible and you subsequently become eligible in the future.
Yeah, so that's an interesting point, because in an environment like this, there may be people, for example, who might find themselves without a job for a period of time, and they may end up claiming certain benefits. Even if they feel that would only be for a short period of time, then they could, in fact, apply for an account and open it. And even if they end up being able to return to work and they are no longer requiring the benefits for support, they could still contribute to it for the 4 years that you've already mentioned. So that is a really interesting feature to pull out for people listening to the podcast.
Yeah, and just to finish off, in terms of actually opening up one of these accounts, it's really, really simple. You go to the gov.uk website, or you can use the HMRC app. And what I'll do is I'll put links in the show notes where we've written an extensive review of the product itself, exactly how it works and how you can apply. And we've also put a news article in there about the new eligibility rule changes. And we'll put a link to both of those articles in the show notes.
Okay, so moving on to the next piece of the show, gold. So gold has been in an incredibly strong uptrend. Now, if you're listening to this podcast, then you're not watching it on YouTube or via Spotify, then there will be a link in the notes to a chart you can go and look at on the Yahoo charts, actually, which is the price of gold. You can go look and see what it's been doing. If you've got an iPhone and you've got the stock app, if you go on there and you search for GC equals F, put that in, you'll get the price of gold, and you can see, if you look at those charts, how gold has been performing in recent months. Now, for those of you who watch this on Spotify or YouTube, that you're going to be seeing now a chart on screen that shows the performance of gold over the last sort of 6 to 7 months, and the performance has been incredibly strong. Now, what's interesting is, if you go back 6 months, we did a piece on the podcast where I looked at the price of gold and the outlook. We'll put a link to that in the notes, because it's very interesting to listen to what I said. And at the time, I pulled up on screen some technical charts like these ones you're seeing at the moment. So technical analysis is a skill or tool you can use to look at charts of price movements of an asset. In this case, it's gold, and you can look at support lines, trend lines, resistance lines, and it can tell you about how the asset might perform in the future. To use an analogy, it's a bit like looking at weather maps. So you might be able to see if it might possibly rain in the next couple of days, but it's no certainty that that would happen. Now, if you go back to October, I was talking about the all-time highs that gold had just hit and the possibility that it could break towards $3,000 per ounce, but also mindful that there could be a slight pullback because we were quite stretched at that point. As it turns out, both of those things have happened. And looking at the charts now, you can see that gold is in a very strong uptrend, and it's actually a long-term uptrend. It's hit new all-time highs, multi all-time highs this year. And as I make this podcast, we've just hit $3,500 per ounce. It pulled back slightly back down to 3,300. But before I look at the outlook and the technical analysis, just to give you an idea of what is driving that exceptional rally in the price of gold. So one thing is central bank buying. So central banks have been buying gold en masse, partly because it's an inflation hedge, partly because it can protect them against sanctions. It can reduce their reliance on the US dollar and actually protect their currency from fluctuations as well. The second driver is the weak economic outlook that we've got globally, but particularly in the US. Now, when the outlook is particularly weak, it means the market starts to price in the possibility of interest rate cuts by central banks. And we've already started to see some of that. And when interest rates are cut, that is positive for the price of gold. You have to remember, gold doesn't produce any income and there's no yield associated with it. So it's an asset that becomes more attractive when the return on things like cash becomes less attractive and the yield you might get on bonds, for example, start to fall. So gold is benefiting from that weak economic outlook. It's also a haven asset. So in times of uncertainty, whether that be war or Donald Trump imposing reciprocal trade tariffs and completely disrupting world trade, then you see a flight to safety. And one of those places is gold, and it benefits from that. And also, when the US dollar starts to fall, which we're seeing now, then that also tends to benefit gold. So we've got this perfect storm, really, that is pushing the price of gold ever higher. And it's actually becoming a bit of a crowded trade, meaning there's a lot of people piling into it. Now, I've held gold for a long time in my 80-20 investor portfolio. I have about 5% always invested in gold as a hedge and a diversifier within my portfolio. And it's been a positive performance contributor to my portfolio now for an extended period of time, and particularly in this recent period of turbulence in bond markets and stock markets as a result of Trump's trade tariffs. So moving on to this sort of technical part, if we're looking at technical analysis, and in the chart on screen we've got a couple of uptrend channels that are drawn. The first one was actually the one that was drawn back in October, and the price of gold was in a definite uptrend. Then it pulled back slightly when it broke below the bottom of that uptrend, and we had a period of consolidation, and then it started another aggressive uptrend. But if you look at the latest channel that's been pushing ever higher since the start of this year, that is an orderly rally. So it's pushing up within that channel. It's not crazy spikes and pullbacks. So that suggests underlying strength in that uptrend. And we pushed through the $3,000 barrier, and then we pushed up towards the $3,500 barrier, which we touched and went just above in the last week or so. But we have seen a little bit of a pullback in the last week, and we're around about $3,300 as I make this show. So we've seen very impressive gains. Just to put that into context, in the last month, gold is up 10%. In the year-to-date numbers, it's up 26%. And over the last year, gold is up 44%. And if you've been paying attention to headlines, there's been interesting numbers being run about how gold has outperformed things like the S&P 500 or the Nasdaq over multi-year time frames. So gold has been performing exceptionally well, and there'll be people listening to the podcast thinking, is it too late to actually invest in gold? Now, it is a very good diversifier regardless of what's going on in the market at the moment, but from a technical standpoint, will it push ever higher? It's interesting that this week one investment bank came out to say they thought the price of gold would hit $4,000, and then the very next day it started to pull back. But looking at the technical analysis and the charts that you can see, the 200-day moving average is the purple line, and the price of gold is way above that, which is very bullish. It's also above the 50-day moving average, which is the red line. That's again very bullish. There's some strong support zones, $3,300, and just below that, and if you're looking further down, $3,250. So if we pull back, look at those areas for gold potentially to bounce from, where people who want to buy gold enter the market because it's now got cheaper after potentially missing out. In terms of upside, there's the resistance zones you've got now between $3,400 and obviously that $3,500. So markets tend to have a bit of a memory, and part of that is because of algorithmic trading, so computers that are triggered to buy and sell things at certain levels. Others because it's just human nature to buy and sell things at certain key points. Round numbers are psychologically very important to investors, and they do have an impact. So at the moment, the outlook for gold is that it's still very strong despite this seemingly parabolic move. Now, that doesn't mean we're not going to get a pullback. I think at some point we are inevitably going to get another pullback to basically get rid of some of that froth and euphoria from the market. But those fundamental reasons why gold has been pushing higher still remain, that I mentioned earlier. Now, there's a host of other indicators you could look at in terms of technical analysis, and one of them is relative strength, which I've talked about before. I'm not going to go into details now, but it does suggest, if you look at the numbers, that it is slightly overbought, which means that obviously it's a very crowded trade, and when things are overbought, then you tend to see a bit of a pullback because of that euphoria that I mentioned, and you can see some of that unwinding. But the outlook for gold is still very positive at the moment. But I would say do keep an eye on that US dollar. If it starts to strengthen aggressively, then that could be bad news for gold. So short term, yes, it's vulnerable to pullbacks. Medium term, then it's still technically bullish. until you get a deeper correction. So keep an eye on those support levels. And again, longer term, that 200-day moving average will be key. Now, I mentioned at the start of the show that this has something to do with home insurance as well, if you're not into investing. Now, importantly, the rally in the price of gold now means that the gold items, maybe jewelry that you have at home, is now worth a lot more than probably when you bought it or when you last valued it. For example, since the beginning of 2024, the value of gold has surged 70%. So if you had a gold item, maybe a ring that was worth £1,000 back at the beginning of 2024, then it's probably worth around about £1,700 now. Now, you need to be aware that if you have insurance, that you normally have to name high value possessions. So if your jewelry has now gained value, it should be named on your insurance. And the other problem is that lots of people now will be underinsured for the value of their item. So they may be insured for a valuation that was made years ago, but the true worth of that item is now more. So if you lost it or it was stolen, then the payout you would get wouldn't be sufficient to buy the same or equivalent item today. So that means that you need to get up-to-date valuations for your gold items that you may have. So that means getting official valuations through jewelers for items that you have that are made of gold, and using the highest one of those to be provided to your insurer. It will push your insurance up inevitably, but if the worst were to happen and things were lost or stolen, then you would be upset if you weren't paid out the full amount. There are other things to bear in mind as well, because if certain items are above a certain value, so jewellery that's above, in some policies, £10,000 in value, it has to be kept in a safe. So if you have a personal possession now that's made of gold that is going to be valued above £10,000, it needs to be put into a safe on certain policies. So you need to check your home insurance policies for that. And in certain circumstances, some insurance companies might need you to take out certain personal possessions cover for very expensive items. Also, always remember to keep receipts of any jewelry that you buy, because if you ever have to make a claim, then that will be useful as evidence to the value of that particular item. But the message is, don't forget to revalue your jewelry over time, because we've been talking about the last year or so, but if you're going back regarding jewelry that you've had for years, maybe decades, then the price will be far higher than when you originally bought it.
Interesting. So, Damien, you mentioned about jewellery there. There'll be people reaching for their jewellery drawers, no doubt. What about other precious metals, things like silver and platinum? Have they had similar increases in recent years?
They've not had quite the same. I mean, silver is like the more volatile cousin of gold, and in most instances, when I'm looking at the charts, the growth in the sort of months and in the last year is much more sort of single digits, but nonetheless, it's still a good exercise. If you're getting gold pieces revalued, then you may as well get other jewelry revalued at the same time, so you can update your insurance policies at once.
Okay, so let's move on to the final piece of the podcast then, and we're going to be talking about Warren Buffett. Now, as if he hasn't got enough money, he's the only billionaire to have actually made money in recent weeks and months, while Donald Trump has been doing what he's been doing. So you're going to explain potentially why that is.
Yeah, so to give it context, I was asked by a national newspaper to give some thoughts as to what ordinary investors could learn from Warren Buffett, given that he apparently was the only billionaire within the top 10 billionaires in the world to make money in the week that followed Donald Trump's announcement of reciprocal trade tariffs. And that crashed the market, as you all probably know, and bond markets also had a wobble too. Now, to give some numbers to that, just to show how Warren Buffett has been doing. Now, his Berkshire Hathaway company, which is the holding company for the investments that he runs, so you can invest in that. Now, that is up 16.78% year to date. That compares to the S&P 500, the US stock market index, which is down 8.4%. So you can see it's not just a slight difference, it's a huge difference. So how did he achieve that? Well, if you look at Berkshire Hathaway, which is the company that Warren Buffett runs, that holds the investments, it was a net seller of stocks throughout 2024, which included trimming its sizable stake in Apple. It's actually the largest holding at the time. Now, Apple's share price has been hit hard by Trump's reciprocal trade tariffs. So if you've been listening to the investment headlines. He put huge tariffs on imports from China. Now, that has impacted the manufacture of the Apple iPhone, for example. So the share price has tumbled. Now, to give you some context, it's down almost 16% year to date. It was down as much as 30% at one point this month. So it's been hit hard. But Warren Buffett trimmed his exposure to that. So did he know something in advance? How did he manage to make a decision like that? Now, you've got to put this into context that this time last year, people would have been raising eyebrows at Warren Buffett for trimming his exposure to Apple, especially that after he did it, Apple's share price went on to hit all-time highs at the back end of 2024. What Warren Buffett actually was doing was selling down his holding because he thought it was overvalued. So the market was overvalued. He's a value investor, so he invests in companies based on perceived value. And he thought the market was looking very stretched, and perhaps he has been proven to have a point. And he moved into cash and short-term US Treasury bills. So he's actually, by sort of late 2024, early 2025, estimated to have cash and equivalent cash holdings for T-bills worth over $300 billion. Now that puts him as holding around about 4% of all US Treasury bills, which is a crazy statistic. So he's moved out the market and into cash, but he hasn't moved out totally. He's just reduced his holdings in some sizable positions, particularly with tech stocks, and he's dripped out of his position. So as a retail investor, one of the big lessons that I pointed out that you could take from Warren Buffett is that it's not an all or nothing affair. You can drip out of positions that you have in your portfolio, whether you're taking profits or it's a position you no longer think is working and you start to move down. People are now more aware of the benefits of dripping in, so taking advantage of pound cost averaging when you're trying to invest a lump sum into the market rather than put it all in at once and risk the market having a downturn. You could instead take advantage of pound cost averaging by dripping in your money over a period of months. So if the market does fall, then you buy more shares for the money that you're investing. You're getting more bang for your buck. So if the market then recovers, you actually make more money than the person who put all their money in at once at the beginning. So many investors don't realize that you can or even take advantage of sizing down positions within their portfolio. Warren Buffett did do that, but Apple shares still were the largest holdings within his portfolio, and I think they are still now within the top 5 holdings within his portfolio. So he just sized down and had a large cash holding. Like I said, it got criticism before, but now people are realizing that it was a wise move. But he was doing it because he is a value investor. He did also invest in other companies, so he wasn't just sitting on huge piles of cash. He was seeking value and did make some selective purchases along the way. So he's still true to that value concept. The other thing to bear in mind from Warren Buffett, if you are an investor, is to stick to whatever investment process that you have. So a value investor, whether it's a momentum investor, whatever your strategy is, stick to it because it avoids the noise. It also means that you avoid that FOMO, that fear of missing out, which is what Warren Buffett did when everybody was piling into tech stocks. At the back end of 2024, Warren Buffett was doing the opposite and sizing down his positions. So when the stock market crashed, that combination of reduced tech exposure, the large cash holdings, helped Buffett weather the storm. And obviously he's getting a good return on those T-bills that he's got when interest rates are high. So in this environment, it's been a good holding for him. Also, you have to bear in mind that he invests in very particular companies, so strong companies, and it means he's got holdings in areas of the market like consumer staples, so things that do well when there are economic downturns. And so his slightly defensive positioning in some quarters of his portfolio have also helped Warren Buffett weather the storm. Another thing to point out is that it highlights that cash is a destination in itself, particularly when you can get a good return on it. It isn't just somewhere that you invest from. It can form part of your portfolio as well. And in a downturn, particularly when bond and stock markets fall at once, which we've seen recently, it can therefore protect your capital. So the final thing I just want to point out as I wrap this up is that Warren Buffett is associated with the famous quote, to be fearful when others are greedy and to be greedy only when others are fearful. And it seems once again he's proved that to be correct with his positioning and his performance. Now, it'll be interesting to see what happens going forward and when Warren Buffett will start entering the markets. But based upon his past successes, being one of the most successful investors of all time, he will probably only be entering the market when he does finally see those value opportunities once again.
Okay, so that's it. We are done for this week. Please do get in touch if you've got any questions about this show or any future shows. A good way to get in touch with us, as always, is to comment on any of the videos that you see on our YouTube channel. You can also comment directly through Spotify itself, and we always look at those comments and we do reply to them as well. And we've also got other ways you can get in touch. You can email us directly, of course, Andy at moneytothemasses.com, Damien at moneytothemasses.com, but all of our socials is really where you should be to catch up with everything at Money to the Masses. So do make sure that you check the description of the podcast, and down at the bottom there you'll see all of our different associated social handles: TikTok, Instagram, Facebook, and all of the rest. Please do like, share and follow everything we do.
Yeah, and just to reiterate, there's so much content now that we're pushing out that isn't going to appear on the podcast ever. There's things that we are reacting to in the market, the news, or things that are just teaching people about finance that don't come to the podcast. So they're very short pieces that can be 60 seconds or less, or they can be more extended pieces but just don't work for a podcast. So do go on there, like and follow us on all of those social channels, because it is our big push going forward. So the one thing you can do for us, do follow us on all our channels. Anything we push out, please do like, comment and share. Finally, if you are using Apple Podcasts or another app, do leave a review. We are going to be reading out some of those reviews in the near future, and you might win yourself a coveted Money to the Masses mug. So that means all that's left for us to do, Andy, is to say until next time.
Until next time.